Hi everyone, I'm Chris Hernandez with Strategic Capital, and I'd like to welcome you to the 401k Corner, where we discuss all things 401k. Since this is our first video, we thought we'd go with the question that we get asked most from the participants inside of the 401ks that we manage, and that is, should I contribute to the traditional 401k or the Roth 401k? So this video is not intended to be investment advice. This is purely educational. We did want to create it though so you know the differences between the two accounts when you're deciding where to put your funds. So today we are going to cover the similarities between these two accounts, but more importantly, we're going to cover the differences. So in my example here, I have a 30-year-old person is making $50,000 a year and they'd like to contribute 10% of their income to the accounts. So if they decided to go into the traditional bucket, $5,000 would go in and they would get a tax deduction. So instead of paying federal income taxes on $50,000, they get to pay taxes on $45,000. Now I want to be really clear, this person did not just save $5,000 in taxes, they saved their tax rate on $5,000. So if they're in an effective 20% tax bracket, the actual tax savings was $1,000 for that year. So that is the first difference, is this person gets a tax deduction by putting money inside of the traditional 401k. If they decided, you know what, I'm going to put my money in the Roth portion of the 401k, the $5,000 goes in, you will see that they pay full federal income taxes on the $50,000. There was no tax deduction for them contributing money into the Roth. So that's one of the first main differences. Now we're going to go over some of the similarities inside of the plan. When money goes into the 401k, doesn't matter what investment options you pick, it's going to be the exact same inside of the traditional and the Roth. When that money goes into the account, they're both going to grow tax deferred, and that just means that the IRS cannot touch it on an annual basis if there's growth in the account. So it allows that money to sit and compound and let that miracle of compound interest take place. Now, because we're getting preferential tax treatment inside of the 401k, the IRS says that we need to keep that money in there for a while. So the IRS says that you cannot touch the money till you're age 59 and a half. If you do before 59 and a half, then there's some penalties and taxes. So now that we've gone over some of the similarities, if I had my person that was 30 putting in $5,000 a year and they were growing their money at 7% a year, 30 years later, they would have about $472,000 in each account. So now that we've gone over similarities, now I'm going to go over the key differences. Because this person got a tax deduction up front inside of their traditional 401k, when they're looking at their statement, they don't really have $472,000. They have that amount minus taxes. So anywhere from 10 to 90% would need to be paid out in taxes. I know 90% sounds excessive and crazy, but during our history, we have had tax rate as high as 90% for top income earners. I actually don't know if you've ever combined the words "the" and IRS, but that spells theirs. The IRS is really good at getting money that is owed to them. So this is the main difference here, is we got a tax deduction up front, put our money in, had that grow tax deferred, and then when it came time to take out, all of it is taxable. The difference on the Roth side is we put our money in, we did not get the tax deduction. The same person's looking at their balance saying, I've got $472,300, and when they go to take it out, they actually have $472,300 because it's all tax-free. So these are the similarities and the differences we wanted to cover. Another question that we get asked often is, what if my company offers a match? How does that work? We like to be really clear on this. It doesn't matter if you decide to put money here, traditional, wherever you decide to put your money. And in my example, let's say the person said, I want to build tax-free dollars, so I'm going to put my money inside of the Roth 401k. The match always has to go to the traditional 401k. So what this person would actually be doing is building both tax-free and taxable dollars. And that puts them in a really good position for retirement because taxes do ebb and flow. We never know how high or low they're going to be. So if this person gets to retirement and taxes are low, they might say, well, I'm not going to pull from my Roth. I'm going to go ahead and pay the taxes from my taxable account because taxes are low. If they retire in a high tax environment, they say, well, I'm not going to pull from my traditional. I'm going to pull from my Roth. So it puts them in a really proactive stance in retirement, which is also a really good thing. So I'd like to thank you for watching our video. In the next episode, we're going to talk about 401ks and individual retirement accounts, IRAs, traditional Roth, traditional 401k, Roth 401k. We're going to get into all the details, limits, everything like that. Please remember to like, subscribe, and comment, and thank you for watching.